being recorded, and we'll be sending a link to the recording to all attendees in a post-event email. We will also be conducting a live Q&A after the presentation ends, so you can submit all your questions using the Q&A box. If you don't see the Q&A box on your screen, you can find it in the toolbox on the left. Finally, we also have closed captioning below if you'd like to follow along with the live transcript. You can also change the language of the closed captioning using the drop-down menu in the closed captioning window. And with that, let's begin.
Good morning, and welcome to our webinar, How to Turn Your Side Hustle into a Full-Time Business and Securing Your First Loan. I'm Randa Chris, and I'm a small business specialist and writer at NerdWallet. Today, we're going to start our conversation with side hustles and break down the steps you need to know to transform your passion project into a thriving business. Then we'll transition into a discussion of business financing, walking you through the things you'll need to get your first business loan. And finally, we'll end with a Q&A. All right, let's get started. Steps to turn your side hustle into a business. Whether you're a freelancer, a dog walker, an Etsy seller, or have some other type of side hustle, if you're thinking of taking things to the next level, you're in good company. Entrepreneurship has grown like crazy in the United States over the last several years. Business application numbers have been steadily increasing since 2020. And in 2023, a record-breaking 5.5 million new business applications were filed. Deciding to turn your passion project into a full-fledged business is exciting, but it also requires research, planning, and dedication. To help you get started, we're going to walk through 6 basic but essential steps that can help you level up your side hustle and give your new venture a shot at staying power. Let's start with step 1. Step 1 is choose a business structure. Even with a side hustle, you've still been running a business. But now that you're looking to expand, it's time to make it official. You've got to choose a legal structure or a business entity type. The option you choose determines how your business is taxed, how it's organized, and who is financially responsible if your business runs into legal or financial trouble. There are 5 common types of business entities. First, sole proprietorship. A sole proprietorship has one owner, with no separation between the business and the owner. All profits are passed through to the owner, which is why a sole proprietorship is considered a pass-through entity. The owner is also liable for all debts and losses, however. You do not have to formally register with the state to become a sole proprietorship. A general partnership. In a general partnership, 2 individuals jointly own a business in which they agree to share the responsibilities, assets, and profits, as well as the financial and legal liabilities. Like sole proprietorships, general partnerships do not need to be formally registered. C corporation. A C corporation is the default type of corporation. It's a legal entity, meaning you must register with the state, that's separate from its owners. Corporations themselves can make a profit, be taxed, and can be held legally liable. S corporation. An S corporation is a tax code designation that allows a corporation to avoid the double taxation associated with C corps and file taxes as a pass-through entity. To become an S corp, you must file a specific form with the IRS, and now that's different than registering with the state. And finally, a limited liability company, or LLC. An LLC is a business structure that combines the simplicity, flexibility, and tax advantages of a partnership with the personal liability protection of a corporation. LLCs provide personal liability protection for their members, but they also can choose how they want to be taxed, either as a pass-through entity or a corporation. So there's so many options, but many entrepreneurs go with a sole proprietorship simply because it's the easiest. It doesn't require you to formally register your business with the state. But a sole proprietorship can be risky. With this type of business, you have no legal separation from your company, so you're personally responsible for any debts or liabilities. Registering for an LLC or corporation is more expensive and requires more paperwork. You'll need to file a legal document called the Articles of Organization or Incorporation with your state. Filing fees for LLCs and corporations can range widely based on your location, anywhere from $40 to $500. The benefit of these entity types, however, is that they can protect your personal assets from lawsuits or bankruptcies. The right entity type ultimately depends on your individual circumstances and where you see your business going in the future. For instance, if you plan to seek outside investors, a corporation might make the most sense. At the end of the day, it can be helpful to consult with a business accountant or attorney for professional advice on which option is best for you. Step 2. Separate your personal and business finances. Mixing business and personal finances can get messy, especially as your business grows. Keeping separate finances makes it easier to track how much money you're making from your business against how much you're putting into it, so you can determine whether you're turning a profit and how much. Plus, you'll need clearly divided finances when it comes to filing taxes or getting a business loan. There are a few easy ways you can separate the two. First, you can apply for an employer identification number, or EIN. An EIN is a unique tax identification number for your business, and despite the name, you don't need to have employees to get one. Think of it like a social security number for your business activities. The IRS can use your EIN to track your business tax returns, and other financial institutions may ask for it as a part of their identity verification processes. You can get an EIN online for free in just a few minutes at irs.gov. Opening a business checking account can also help you separate business and personal finances. This unique account allows you to keep business income and expenses organized and easily accessible. Look for a business account that has low or no monthly fees and fits your needs in terms of transactions and deposit limits. And finally, a dedicated business credit card can also be a good way to pay for day-to-day business expenses separate from your personal ones. Like a business checking account, business credit cards can help you track expenses as well as identify tax deductions. Plus, you can earn rewards from areas where you spend the most, like gas, office supplies, and internet services. Step 3, formalize your business plan. Your side hustle may have started organically, but turning it into a full-fledged business requires research and strategy. And that's where your business plan comes in. A business plan explains what your business does, how it makes money, who its customers are, and it outlines your financial goals and how you plan to reach them. A thorough business plan will describe your products or services, as well as who your competitors are and how your business will stand out from the crowd. Conducting market research will confirm whether there's a need for your unique business, as well as help you price your products or services competitively and determine your target audience and how you'll best reach them. When writing your business plan, you should also sketch out short and long-term goals, along with a sales plan, financial projections, and potential roadblocks. You want to be realistic, set specific targets, and spell out how you plan to reach them. Building a business plan gives you a roadmap for how to grow your business. It also shows lenders you've done your homework, should you need to secure a business loan. Keep in mind, though, that your business plan is never truly done, especially as a new company. As your understanding of your business, the market, and your customer base changes and adapts, so should your business plan. For some business owners, a monthly or quarterly cadence to check in, reprioritize, and shed the things that aren't working may make the most sense. Others may find it more useful to revisit their plan when there are new insights or significant changes to the market, such as new regulations, nearby real estate developments, or fresh competitors. If you need help with your business plan, your local Small Business Development Center is a great resource. These outposts are run by the U.S. Small Business Administration and offer free business consulting services. Step 4, start bookkeeping. With your side hustle, you may have gotten away with using a manual spreadsheet to track your income and expenses, or maybe you haven't been tracking them at all. Now it's time to get organized, and accounting software can help. Simply put, accounting software tracks the money going into and out of your business, and good accounting software will help your operation run more smoothly. It allows you to track cash flow, manage customer invoices, as well as generate reports and financial statements so you can see how your business is performing and make adjustments as necessary. These reports and statements will be especially useful as you update your business plan, file taxes, or prepare a business loan application. Expect a learning curve with any new system, but know that this type of software can keep you organized as well as give you valuable insights into your business. If you add an outside bookkeeper or accountant to your team down the line, they'll also be able to access your accounting software to collaborate in real time. So consider a solution that can grow with your business. Step 5, invest in professional help. By nature, entrepreneurs wear many hats, but maybe you don't need to wear all the hats. Outsourcing some aspects of your business frees you up to focus on other things, like customer service or product development. If you're not up to date on the latest social media, for example, you can consider hiring someone to build and manage your business's presence on social media platforms. Similarly, if you're not comfortable sorting through tax forms, you can invest in a certified public accountant to file for you. And if you feel like you just need advice, you can seek out an organization like SCORE that provides free business mentors with expertise in subjects such as finance, branding, legal, marketing, sales, and more. These professionals can offer personalized advice and support as you make your way through your business journey. You can also find professional support and services at your local Small Business Development Center, as well as through national or local business organizations and trade groups in your industry. And the last step, step 6, consider startup funding. As you build out your business and start investing in things like software subscriptions, professional assistance, marketing initiatives, and more, you may find yourself in need of capital. As a new operation, it can be difficult to qualify for a traditional business loan, but there are other funding options available for startups. Here are a few you might consider. Family and friend loans. As the name suggests, a friend and family loan is when you borrow money for your business from a close friend or family member. These loans are typically very informal. They don't require an application process or a credit check. If a friend or family member is willing to give you a loan, however, you should make sure to create a written agreement with the loan terms. It's also important to keep in mind that you could potentially damage a close relationship if things don't go as planned. Personal loans for business. If you have a strong personal credit score and strong income, you may be able to qualify for a personal loan that can be used for business purposes. These loans can be a good option for smaller capital needs. If you take out one of these loans and can't repay, however, your personal credit and assets can be at risk. Crowdfunding. Crowdfunding allows you to tap into the power of the internet to raise money for your business. You use a crowdfunding platform to create a profile, set a funding goal, and publish a request online. You then share your campaign with customers, social media followers, friends, family, in order to gather donations for your business. In exchange, you typically offer your supporters something in return. You might offer equity in your company, a reward, like a new product, or exclusive access to an event. This can be a good funding option if your business has a strong customer base or a large internet presence. And finally, small business grants. Small business grants provide free access to capital that doesn't need to be repaid. Grants are available from government agencies, state organizations, and private corporations. It takes time and effort to find and apply for business grants, however, and competition is high. As your company matures, you'll be more likely to qualify for traditional business loan options like bank loans and lines of credit. It's important to understand, however, that getting approved for a small business loan isn't always easy. It's a process that takes time and preparation. So let's talk about tips for securing your first loan. We'll walk through the key factors that lenders consider when evaluating your business loan application. By understanding these requirements before you're in need of funding, you can improve your business metrics so that when you're ready to apply for a loan, you have your choice of products and can opt for the most affordable and best fit for your business. The first factor is credit score. Your personal credit score is determined by factors such as whether you pay your bills on time, the amount of your credit limit you use, and the length of time your credit accounts have been open. Business lenders use your personal credit score to assess your ability to manage and pay your debts. In general, the higher your personal credit score, the more likely you are to qualify for funding. A strong personal credit score can also help you qualify for lower interest rates and longer repayment terms. Credit scores themselves typically range from 300 to 850. An excellent score is a score of 720 or higher. A bad score ranges from 300 to 629. If your credit score isn't where you want it to be, start by checking your credit report for errors. Errors may include accounts that aren't yours or you didn't authorize, incorrect negative information, or negative information that's too old to be included. Most negative information, other than one type of bankruptcy, should be excluded from your report after 7 years. You can use annualcreditreport.com to get a copy of your credit report for free. If you find errors, dispute them with the appropriate credit bureau. Typically, the fastest way to file a dispute is online, but you can also call the credit bureaus or send a credit dispute letter by mail. You can also build your credit score by making debt payments more frequently, paying down, or paying off debt. If you're an established company, your lender will also look at your business credit score. Scores evaluate your business's creditworthiness and ability to handle debts based on factors like payment history, available credit, and judgments such as tax liens or bankruptcies. Business credit scores are available from 3 commercial credit bureaus: Experian, Equifax, and Dun & Bradstreet. and typically range from 1 to 100. Like personal credit scores, the higher your score, the better. To build your business credit, you can consider opening a business credit card, pay your creditors on time and early if possible, establish trade lines with your suppliers, and avoid judgments, liens, and bankruptcy filings in your business's name. The next factor is your time in business. Lenders use your time in business as a quick measure of success. The longer you've been operating, the more likely you are to have money to repay your debts. Most traditional lenders, like banks and credit unions, will want you to have at least 2 years in business. Businesses that don't meet that threshold are often referred to as startups and have fewer funding options available to them. However, online lenders may only require a minimum of 6 months in operation. Keep in mind, though, that this type of funding is typically more expensive than a bank loan. The third factor is business finances. Your business finances speak volumes. Lenders want to see evidence of stable cash flow to ensure that you can repay a loan. To evaluate your finances, you'll likely need to provide business bank statements and tax returns. You'll also need to provide financial statements such as balance sheets, profit and loss statements, and cash flow statements. Many lenders will also ask you to meet a specific monthly or annual revenue requirement. This requirement can range anywhere from $36,000 per year to $250,000 per year or more. If you haven't been operating for very long, it can be very helpful to provide sales forecasts that illustrate the potential revenue your business will generate. Another financial metric your lender may consider is your debt service coverage ratio, also known as DSCR. This ratio compares your available operating income to your current debt obligations. To calculate your DSCR, you divide your annual operating income by your total annual debt payments. For example, if your annual income is $150,000 and your total debt payments are $100,000, your debt service coverage ratio would be 1.5. Generally, lenders want to see a ratio higher than 1, typically a minimum of 1.25, as this indicates that your cash flow is sufficient to cover your debt obligations. The next factor is your business plan. A detailed business plan helps give lenders a deeper look inside your company's goals and strategies for achieving them. This document should show lenders that you have a strong business model, a profitable market for your products or services, and financial projections to prove your creditworthiness. You should also include a loan proposal as part of your business plan. A loan proposal describes how you'll use your funding and how you expect to repay it. A business plan is particularly important for new businesses that don't have an established record of success. If you don't have existing revenue to show a lender, a thorough business plan can help convince them that you'll be successful in the future. This document also gives you an opportunity to show a lender your character. You can include resumes for your management team that highlight their business experience, letters of reference, and any other supporting documents that show your strengths. Overall, your business plan should give the lender more confidence in your business, increasing your chances at loan approval. And the final factor is collateral. Collateral often refers to physical business assets, such as savings, inventory, real estate, or equipment that are used to secure a loan. When you put up collateral, it provides security to the lender. If you can't repay the loan, the lender can claim your collateral and sell it to cover their losses. Not all lenders will require you to put up physical collateral to secure your loan, but providing collateral, especially when it's not required, can help you qualify, especially if you're a newer business or have a lower credit score. It's important to keep in mind, however, that most business loans will require another form of security called a personal guarantee, regardless of whether or not you provide physical collateral. A personal guarantee is an agreement that holds you personally responsible for the debt if your business can't repay. Similarly, some lenders may take out a uniform commercial code lien or UCC lien on your business. A UCC lien gives a lender the right to claim your business assets in the case of loan default. Remember, it will take time to get your first business loan. Understanding lenders' typical requirements, however, can help streamline the application process. Keep in mind, though, that some lenders do have different qualification requirements. If you're unsure of what a lender requires or have a question about their requirements, make sure to reach out to them directly for more information. And finally, here are some other tips to keep in mind to help you get the best loan option for your business. First, leverage your existing financial relationships. Some banks, especially local or community institutions, may be more flexible with their qualification requirements or offer other benefits like interest rate discounts if you already have a relationship. You might consider starting your loan search with the institution that administers your business bank account or one that has issued a loan for you in the past. Second, don't rush the application process. When you complete a loan application, it's important to verify all requirements and read each question carefully. Providing incorrect or outdated information can significantly slow down the application process and sometimes result in an automatic rejection. If you're applying for a loan online, for example, and the lender uses automated underwriting technology, inputting inaccurate data can trigger a rejection regardless of the strength of your credentials. And finally, seek expert advice. To help guide your funding search, especially when you're getting a business loan for the first time, it can be useful to work with a free or low-cost business advisor through an organization like SCORE or your local small business development center. Experts from these organizations can help you organize your finances, compare funding options, and even prepare and submit loan applications. Some lenders, like community financial development institutions or CDFIs, and nonprofit organizations offer similar advisory services in addition to their own loan options. Any questions?
All right. Hello, everybody. I hope you enjoyed that presentation. We're going to get into Q&A with Rhonda. Hello, Rhonda. The first question that we have here is, how long does it take to officially register for an LLC? Or do you get approved instantly once you submit your documentation?
So when you register for an LLC, it's not an instant approval process after you submit your documents. It typically takes time for your state agency to process and approve them. Now, that timeline can vary based on your state. It can take anywhere between a week and 10 business days typically. That said, processing is usually faster if you submit online versus submitting your paperwork in person or mailing it. Some states also allow you to pay an additional fee to get expedited processing, but again, that'll vary by your state. There are also some times of year that are usually busier than others for processing times, usually at the beginning of the year and at the end of the year. So it might take longer during those periods.
All right. And then another question that we have here is, will opening a business credit card hurt my personal credit score?
That's a great question. Applying for a business credit card will likely result in an immediate but temporary hit to your personal credit score. And that happens when the card issuer does a hard inquiry on your credit report. Typically, credit card issuers rely on your personal credit for approval. And so that's why that will occur. But this decline in your personal credit score will likely be short and small. Um, Beyond that, your business credit score will likely only hurt your personal credit if you consistently make late payments or fail to make payments at all. Several business credit card issuers will report late payments and serious delinquencies to the consumer credit bureaus, and that will negatively impact your credit.
All right. And the next question is, how does accounting software, how much does accounting software typically cost? Is this a monthly fee or an annual fee?
So there are free options for accounting software, but for others, the costs can range. Some may cost upwards of $200 per month. Generally, providers price their subscriptions on a monthly basis, but some may offer annual subscriptions as well. You might be able to save money actually by committing to a yearly subscription, but the downside of that is if you decide to cancel before the year is up, it's unlikely that you'll be reimbursed for what you've already paid. Ultimately, the cost of your accounting software typically varies based on the included features and capabilities, as well as the number of users you need.
Right. Then another good question is, when thinking about investing in professional help, if you have a friend or relative who is good at, for example, social media, should you go that route because it might be cheaper, or do you think it's best to separate family and friend from your business?
I would say if you have friends or family who are willing to help you and have expertise, they can definitely be a great resource, especially when you're first getting started. However, this is definitely a personal choice, and so it might not be right for everyone. If you think it's something that might work for you, the best thing you can do is set guidelines and expectations with the person who's going to be helping you ahead of time, and that will help you preserve your personal relationship with them. As an example, you might draft a scope of work that includes what you want them to work on, how often you're going to have them working with you, and any payment if that's something that you're going to do. And you can review that document with this person. You might also schedule a regular meeting to discuss updates, to let them ask you questions. It can really be useful to think of this situation like working with an independent contractor, and that can help you set boundaries between your working and your personal relationship with this person.
Yeah, and we have a question here about grants. How much is a typical small business grant? Any recommendations on how to stand out and get funding this way?
Sure. So I would say there's not really a standard small business grant amount. It really varies based on the grant itself and the program that you're applying for, but some start as small as $500. In terms of ways to stand out and get grant funding, I have a couple of tips. First, I would say start local. Your state or local government may offer business grants. Local community groups or business groups might also offer them. And you often have less competition locally than you might with some national grant programs. So that can be a great place to start. Next, I would say when you're searching for grant options, try narrowing them down based on your business's mission, industry, and values. These attributes can help you find grants again with less competition and put you in a place where you're highly qualified for that program. If you're a restaurant, for example, you might find grants that are specific to food service businesses. Or if you're a sports focused business, you might find grants from nonprofits that are dedicated to promoting exercise. And finally, I would say don't be afraid to showcase your business. Many grant applications are really involved, they have a lot of components, but you should really look at this as an opportunity to tell your story. If it's optional to include a video as part of the application, include a video. Try and get creative as much as you can. That will help you stand out against other applicants.
All right. And then here's a question about loans. How much more expensive is an online lender than a banking loan?
That's a great question. I would say ultimately it really depends. Based on the latest Federal Reserve data, average annual percentage rates on bank loans for businesses can range from about 6% to 13%. Online loans, on the other hand, have a much wider range. They can range anywhere from 6% all the way up to 99%. That said, if you have strong credentials like good credit, multiple years in business, and strong finances, you can definitely get an online loan that costs about the same as a bank loan. But because online lenders are more flexible and accept more borrowers, their rates can become much higher.
Yeah, and then another question here is you mentioned including a letter of reference in addition to your business plan if you don't already have existing revenue. So, who would you recommend asking for those letters of reference? Previous employers?
Yeah, so I would say feel free to ask anyone who can vouch for your financial stability, your business acumen, and your ability to manage your financial responsibilities. So this could include previous business partners, employers, business professionals like accountants, lawyers, or advisors who may have already reviewed your business plan or your loan proposal, and even respected community members. All of these people could be good options for getting one of these letters.
All right. And another good question here is can lenders take my personal property as collateral? For example, my home, or is it just collateral related to my business?
So generally, you'll just want to use your business assets like equipment or inventory as collateral for a business loan and not personal property. Most lenders will ask you to sign a personal guarantee, which says that if your business can't repay the loan, you will be held personally responsible. And in that case, it means if you were to default on that loan, the lender does have the option to use your personal assets to recover their losses.
Yeah. And then the next question that we have here is if I already secured my first loan, but want another, should I stick with the same lender or should I shop around?
That's a great question. I would say generally it's helpful to shop around and compare multiple lenders to see which one can best meet your needs. Comparing multiple options can help you find the most competitive interest rates and repayment terms. That said, there are some advantages to working with a lender you have an existing relationship with. For example, if you've already gotten a loan from a lender and responsibly repaid it, the lender may be more likely to work with you again, especially compared to a lender that you've never worked with. Another example, some lenders also offer perks to borrowers who do continued business with them, like interest rate discounts. And another thing to just keep in mind is if you've gotten a loan already, but you have not repaid it, I wouldn't recommend getting another loan, and many lenders wouldn't approve you for another loan. Trying to repay two loans at the same time can be extremely difficult and can really cut into your cash flow. And that can create a cycle of debt that's difficult to break. If you have an existing loan and you think you need additional funding, I would say talk to your current lender about possible options that you have there.
All right. And then another good question is I've been denied by a lender and can't seem to secure one. What are your tips?
So I would say the first thing that you can do in this scenario is to ask the lender for an explanation on their decision. You might be able to address the concerns that they have and then reapply for the loan. As an example, if the lender's decision was based on a poor credit score, you might be able to take steps to improve your credit score. Similarly, if the lender felt the loan was above their risk tolerance, say because your business is too new, you might be able to offer collateral or a cosigner to lower the risk for that lender. Another option that you have is to try a different type of loan. If you've been denied a bank loan or an SBA loan, for example, you may be able to improve your odds of approval by looking for loans that have more flexible qualification requirements. Microloans and loans from CDFIs or certified development financial institutions can be good options because they typically have more flexible qualification requirements, but they still offer competitive rates and terms. And these lenders usually prioritize working with traditionally underserved borrowers and can offer business training and assistance in addition to funding. And then finally, in this scenario, I would say you can also consider non-debt-based funding options. So if you're working on building your credentials, but you still need capital, you might try non-debt options like grants or crowdfunding.
All right. Well, that is all the time we have all the time we have for questions today. So I want to thank Rhonda for your presentation. Thank you so much, and thank you for answering these attendees' questions.
No
All right.
problem.
Thank you so much. Yeah. And so with that, we'll go ahead and close out today's webinar. Just be aware the next webinar will be starting at 3 p.m. Eastern time. It looks like we still have a little bit of time, feel free to go back into the webinar hall and see our previous webinars. You'll be able to view those, the webinars we did yesterday. Maybe you missed some. You can view those there while you wait on the next one to start at 3 p.m. So with that, we'll go ahead and close out today's webinar. Thank you so much and have a good day.